Hey guys, this is Market Update. I think the last few weeks have been very important from a price action standpoint, right? We've now got 4 weekly candles in green, a huge bounce from the 50-week moving average coming up into all-time highs again. 100K is an important level. That's not bear market price action, is it? This is bull market price action, bouncing from the trend line, bouncing into highs, testing those highs again. We've bounced up with the stock market as well. You've got some risk on there, so I'll go over that in this video and some behind the scenes things that are happening that I think are pretty positive for risk assets. So before we get into that, I have updated the crypto course. If you're a member, go and watch these videos. Macro update here, analysis on strategy and all of the different securities that they've been issuing, right? Because they're obviously doing very well. My portfolio update as well. I've also got a discount. Type BTC at checkout, you get 20% off this month, link in description. If we look at the price performance of BTC as well, it's been really good through this period. So I just think that Bitcoin has this natural organic growth in it, right? And money is flowing in from TradFi. And so if you take a look at correlations when the market goes risk on and risk off, of course Bitcoin is going to have a correlation to risk, right? Because it is risk. People are flowing into the asset. Everyone's trading it, right? So it's going to have correlations. But it has this organic growth that's outperforming. And you can just see that. And you can see we're in a bull market. What I mean by that is from the all-time high, Bitcoin drew down 27%, right, during all of this tariff tantrum. And the NASDAQ in purple here drew down around 22%. Right, so you're getting what, like 1.2 to the downside in terms of extra vol, but to the upside move, Bitcoin's up 27%, NASDAQ recovering 15%. So you're looking, let's say 2x, right, 1.8 or something like that correlation to the upside, right? So that is amazing to put into a portfolio. Yeah, you get extra volatility, but the downside volatility isn't 2x with 2x upside, 1.2 versus 2. That is very, very good to add to a portfolio. We know that, right? Bitcoin is just outperforming. You zoom out, Bitcoin is outperforming, right? So you need this in your portfolio because it is the outperformance and it's not stopping. We've bounced again. When markets go risk on, it goes risk on to the upside even more. So you have to have it in your portfolio, right? And we know we're in the right asset and there's still money pouring in. You can see that there's still demand from TradFi. That money is only growing larger that can flow into the asset. There's still a lot of uncertainty about economic growth and the potential tariff impact. We'll put that to the side for now. What happened recently was the MOVE index spiked to a level where it drew a reaction from the Treasury. And the MOVE index is it's an index of the volatility of US Treasuries, right? So how volatile are US Treasuries? Now, you know about volatility if you're a Bitcoin holder, right? We know about volatility and we have a bull market, which is great. And then we get drawn down on 70% and it's difficult, right? It's like, how do I run my life with this? Because I know this is a great asset, but the volatility is great because I'm getting upside, but obviously in a downside, you have to manage your cash and it's difficult, right? Well, just imagine that, but the whole world is actually collateralized on treasuries and not Bitcoin, right? And so you're seeing this MOVE index spike to a level where the whole entire market becomes so uncertain, liquidity dries up, people don't know what to do, right? So that is impossible for this market. We know this market is unsavable, right? It is literally a massive inflating scheme that has to be constantly filled and filled and filled with new debt. They can't pay the debt. They actually need to create debt to pay the debt because the debt is the money is the debt. And if you have to pay the debt, that means you need to create more debt because you need more currency units to pay that, right? So we know about that scheme, but it's so volatile that they've stepped in and said, look, we need to figure this out. So they come out, the Fed says, look, if things get uncertain, and they mean the Treasury market, they don't care about the stock market, it's the Treasury market. If things get uncertain, we have our tools. The Treasury said we have our tools, and this is a little step towards that. It's not a massive difference, but the fact that the Treasury is stepping in with something and trying to increase liquidity and trying to calm markets, they do calm markets. And if people are calm in the bond market and rates are coming down a little bit, that can increase liquidity and risk-taking in risk assets. So Treasury will be guided by the objective of financing the government at the lowest cost over time. Now that's important because it ties in with what 2-year rates are doing right now. This is a really important thing to get. I know it's a bit complex, but essentially most of the Treasury's refinancing is on the short end, like 1 to 5 year. And that's because they don't have enough buyers on the long end, 10, 30 year, to actually refinance any amount of that debt. There's no buyers there, right? Not for the amount of debt that they have to refinance, not for the amount of debt they have to create. And so if they issue out there, it's going to be so high, you're going to push rates up, right? So they have to issue on the short end. And on the short end, what's happening is you're getting a slight economic slowdown, rates are coming down, and they're starting to essentially mess with the duration of their bonds and what they're issuing to reduce potential interest rates. And that can increase liquidity. 2-year coming down, more debt issuance there. It can increase liquidity, which increases risk taking. Bitcoin goes higher, stock market goes higher. It's a buyback program. What exactly is that? They're simply trying to rejig their debt and increase liquidity. Increase liquidity in markets can help risk assets. So you've got here all of these operations: liquidity support, cash management, liquidity support. Look, it's $4 billion per operation, right? So it's not a huge amount. And maybe, reading too much into it, well, they're pumping markets, but there's more ways to increase liquidity just than the Fed saying we're going to print money in QE. That is a emergency thing, and they're going to do everything they can around that before they actually get to that. Maybe they do it in the future again, and we'll have to go through some sort of recession to see that, and that means volatility downside, but huge upside because they're printing money. Assets are going to roof when they do that. In the meantime, they can very clearly support markets through these other things that they can do, right? So they've said that. They basically capitulated, said, move index spike too high. We need to calm things down. We're going to come out and say, look, we can do this. Now, they're also looking at 2-year rates, which is important because a lot of their debt is refinanced on the short end. And so short end rates matter. And with all of this tariff uncertainty, you're getting GDP downgrades, which is perfect for what they need to do, because they need to refinance the debt by creating more debt, right? The currency is the debt is the currency. How do you pay this debt? Well, I don't have any currency. So how do you create the currency? Create more debt. So the interest rate on that debt that you create is absolutely important for how much you can pour into markets, because a high interest rate means a fiscal position is worse, become more unlendable. Interest rates go up, which is not good. If interest rates are coming down on the debt that you have to create, that's good. And that's good for markets. And you can see that the market is driving the 2-year down right here. And, Besant is saying, look, I'm not going to tell the Fed what to do, but the market is telling them that they're going to be cutting soon. If the market is pricing in cuts soon, that means that they will also be taking risk, potentially in risk assets, because the market is saying, rates are too high, and we know you're going to be coming down soon. The Fed are going to be the last to move, but you can see the market actually moves before the Fed. So to the upside, the market is moving up to the level before the Fed, then it moves down. Before the Fed, it crosses over and comes down, and then it moves up before the Fed, and we're now moving down. So interest rates are coming down, and everyone's sniffing it out. It's like there is some economic slowdown, but we know that the Treasury can increase liquidity. We know that the Fed are going to cut interest rates, and the interest rate cuts are going to be more and greater than we were pricing in. And so lower interest rates, lower borrowing costs means potentially more liquidity in markets to drive up asset prices, because they need those asset prices higher, right? And without real economic growth or GDP growth to do that, then you need to muck with the currency again, and that's exactly what they're going to do. So look, the danger, right, is that tariffs and everything cause an actual recession, and then it snowballs. That's the danger, and we have to have that volatility, downside volatility in mind, because it always may happen. But I know that the trade here is that you buy assets because if any slowdown happens, they always step in with this policy to increase liquidity, drop rates, print money if they need to. On the fiscal side, they can cut taxes. You can see we're pricing it in now. We're starting the drop. And so at some point, the Fed's going to be cutting rates. And they're going to try and increase liquidity in markets and create inflation. They need inflation. They want inflation. They create inflation. And that creates inflation in asset prices as well. We're starting to sniff that out. Over the last decade or more, we've been primed to look for the Fed's reaction to weak markets and then printing money. Right, and that's worked because markets are weak, the Fed prints money through QE or one of the other measures, markets go up, and that's easy. The Trump admin wants to return credit creation to the private sector. The private sector is primed to be the driving force of the next generation of economic expansion. What they mean by that is there's debt that needs to be paid, and the only way that you pay debt is by creating new debt, because the debt is the currency. So how do you pay off existing debt unless more currency is created to pay it off? And then you create that currency with interest, that has to be paid off by more debt creation elsewhere. So instead of the central bank doing this and printing money, what they're trying to do is expand that from the private sector. So they want to deregulate small and medium-sized banks. They want to encourage credit creation from small and medium-sized banks. They want to sort out the supplementary leverage ratio, which is going to increase the amount of currency units that banks can create, and they can take more risk. They want banks, commercial banks, to create this credit and force it into the economy. And that's going to create inflation and GDP expansion, which is hopefully going to reduce the debt to GDP. You can't reduce debt, you can't pay it off because it's currency. Currency is debt. You can't pay off the debt. If you pay off all the debt, then there's no currency because the currency is the debt. So you don't pay it off, you create new currency units and you pay that off with the new currency units, then those new currency units are there, so you need more growth and more growth in those currency units, which is inflation and GDP. They want the private sector to do this, which is meaning, I think, that it's going to be volatile and uncertain in terms of this credit creation, because the central banks like print money, print money, print money. Well, commercial banks actually have to have a reason to do this, and that's why they're bringing back manufacturing. So it's going to be uncertain and volatile, but they are going to create new currency units and push GDP and inflation higher. That's what they call growth. They can do this as well because all of the inflation metrics are coming back to trend. Once inflation is back to trend or even lower than trend, they can start saying, increase currency units, take risk, lower interest rates, create currency units with lower interest rates. That increases GDP and inflation. It pushes asset prices higher. Think about the next few years, right? We're coming down now into lower inflation or at trend inflation. And if this continues to come down, all of this is lagging, so it will. Then they can start the next range of inflation and credit currency unit expansion. PCE inflation 2.3, their target is 2. So it's looking back to trend. PCE inflation coming back to trend. You've got wages and salaries coming back to trend. Government workers' wages and salaries coming back to trend. So if it's at trend, they don't have to be so hawkish and at 4% rates, do they? Continuing claims, little bit higher. It's important to watch. If the market gets a little bit soft, the jobs market, they can come way easier in policy as well. And so they start creating those currency units, start creating the next round of inflation, which pushes asset prices higher. Now the danger is it spikes up, which is not good, and everything's going to crash. But then the Fed will come in and drop rates to zero and print money again. So you have to be in assets. 20% discount on the crypto course. Type BTC at checkout. These updates are free for existing users and free forever for existing users. And if you want to get a $30,000 deposit bonus on Bybit, link below for that as well. I'm James, it's Managing G. Cheers for watching, and I'll see you in the next one.